The UBS Real Estate Bubble Index report is back for another year, and this year we're featured in #1 spot. And this is one of the few times we do not want to be there. This can be pretty scary for some people, and yes, even though housing prices have gone up like crazy in the past few years, it still doesn't really make much sense that Toronto is less affordable compared to cities like London, New York, or even LA. And so I'm here to break down the report and give you the real facts. But before I continue, if you enjoy content like this, don't forget to give this video a thumbs up and subscribe to our channel so you can see more videos like this made specifically for real estate investors in Toronto. In their Bubble Index report, UBS uses 5 metrics to rate and rank cities: the price to income ratio, the price to rent ratio, the city to country ratio, the mortgage to GDP ratio, and the construction to GDP ratio. 2 out of these 5 metrics are based on price, and so if price growth has been really strong lately, you can pretty much bet that that city will be high up there in the UBS rankings. But the less obvious thing that not a lot of people can see is that they're actually stacking how a city is doing in 2022 against how that same city is doing since the 80s, and not that city compared to another city. Take a look at this chart, which basically shows the price to income metric between cities, where they show how many years it takes for a worker to be able to buy a home in various cities. Higher on this chart means that a city is less affordable, and as you can see, Toronto is actually sitting close to the bottom of the chart. Here's another way to look at things. It takes someone in Paris 15 years to buy a home, and yet they're assigned a yellow dot, which means that they're at a lower bubble risk. In Toronto, it takes 7 years, but we're actually a red, meaning a bigger bubble risk. And this is really because of the way UBS interprets these numbers, comparing a city with its historical self instead of a city with another city. It's true, our affordability has gone worse over the years, and this is why we're getting a big red flag. And it's not because we are less affordable compared to other major cities. Basically, it's just because we are moving up in the ranks as a global city, something that we really weren't before, and this is why our prices have gotten more and more premium in recent years. Our price to rent metric is also coming in red for pretty much a similar reason. On a global scale, we are sitting right in the middle, but we are marked as red in the UBS price to rent metric. Tokyo and Singapore are sitting higher on this global scale, and yet they are yellow instead of red. The one thing I do want to highlight from this section is that rent growth is a global theme and not just something unique to Toronto. Urbanization is back on track across the world, and it seems like all in all, strong rent growth is happening across all major cities, and renters are coming back to the cities. Now, moving on to the city to country metric, we're actually a yellow dot, which is actually better than many other cities around the world. And that's simply because fundamentally, Toronto is much stronger than Canada as a whole. Even though Canada has aggressive immigration goals, most new immigrants actually end up coming to the GTA. On the supply side, we're probably the only city in Canada that has a real housing crisis. We don't have any more land to build out, and so the only way is really to go up, and there is a lot of red tape for densification. So moving on, we're sitting in the red in terms of the mortgage to GDP ratio. And here I would have to agree that Canada's homes are highly leveraged, especially more so in recent years with a growing number of real estate investors. So it is a fact that this will make our housing market more volatile and more vulnerable to interest rate movements. In our current situation where prices are coming down, this does mean it is possible to see bigger swings downwards in Canada compared to other cities with lower debt ratios. And it's not just our city in Toronto. The only other Canadian city on this chart, Vancouver, seems to be also seeing the same problem. So let's move on to the last construction metric. Here, UBS stacks a city's construction against its country GDP, which honestly is a little bit off, especially over longer periods of time. Perhaps 30 years ago, the growth in Toronto might have been more in line with the rest of Canada, so you could do this. But in more recent years, Toronto's growth has been much faster. So what this means is that the pace of construction should grow a lot faster than the rest of the country. And so a higher number is normal, and it shouldn't really be an indication of a housing bubble. As you can see, I do have some issues with the UBS methodology, and so I would advise you to take this report with a grain of salt. From a global standpoint, we're actually still very affordable. And are we in a housing bubble? Looking back, we probably were towards the end of the low interest rate era. And like I said, Canada real estate probably would see bigger swings due to our buyer profile. And so we were probably more overpriced than other cities in this report. But our prices have fallen 25% from the peak in Toronto. And this UBS report actually only looks at data until the end of June. Since then, prices have continued to fall and rents have continued to shoot up. And so it's possible that we may have come down in ranks since then. One last suggestion from us to UBS is that it might be a good idea to consider a city's growth prospects as another metric. If you see high price growth in a city like Hong Kong, where the population is actually on the decline, there's less of a reason to support the sustained price growth, and so this should be a big bubble risk red flag. But when you see growing prices in Toronto, a city with fast population growth and a housing crisis, that just fundamentally supports prices to continue to go up. So adding this consideration should help balance out a lot of the concerns I've had with the UBS methodology. I do encourage you to read past the scary headlines to understand the full picture. The news is always made to scare you, and even iBank analyst reports might not tell you the complete story. At the end of the day, the takeaway is that Toronto has been a growing city in recent years, and this is why our price growth has been so strong. And the other good thing to know is that the draw to urban centers hasn't gone away after COVID. When we combine what's been happening lately with the federal government's strong projected immigration goals, higher interest rates probably won't keep prices dropping in Toronto for long. So if you are interested in entering the Toronto real estate market and you want to find out more about what's going on, we'd be happy to chat. We're a real estate sales brokerage that focuses on investing in real estate in Toronto, and we're all about making decisions with numbers. When you work with us, we take the time to understand your needs, teach you the ropes, show you all the deals that fit you, and eventually help you buy the best one for you. But that's not all. Our team also provides renovations guidance, leasing, and property management if you need it. So just connect with us if you want to learn more about our services by heading to the link in the description below. Don't forget to give this video a thumbs up and look for us on Facebook, Instagram, or LinkedIn if you want to hear from us more regularly. I wish you all the best in your real estate investing journey. Thanks so much for watching, and I'll see you in the next video. Bye.